Good morning and welcome to our first edition of Between the Lines Live for 2023. So a very exciting time. My name is Vanessa Rader. I'm the Head of Research for Ray White Group and I'm joined here today by Hetherington. Ian is our Director of Ray White Capital Transactions. So welcome, Ian.
Morning, Vanessa. How are you?
Yeah, good. Now, very exciting to have Ian on board. So, Ian, we've known each other for a good 20 years, I suppose, from
I feel sorry for you.
Our Ray White, our time at CB Richard Ellis at the time it was called. So it's great to have you back to be working with you in the Ray White business. So we'll first start just to talk a little bit about that. So you've been feet under desk now for 6 months with Ray White Capital Transactions. How have you found it?
Oh, it's great. Obviously, I'm not going to say it's bad, but I can generally say it's great. It's great to be associated with such a powerful brand and the strong family values. And it's, all ahead of us, and it's up to me and my team to succeed. And it won't be for the lack of support and enthusiasm and input from the broader Ray White Group.
Yes, that's exciting. So you have a team here and it's just looking to grow?
That's right. David Cunningham joined us from Investor Property Group and Ursula Hunt joined us from AMP. So very strong institutional background and knowledge that we bring. Of course, with my I guess I'm a salesman. So we've got some professional people and grubby salesmen. So it's a nice balance.
Call it that. But so you've started with a bang. So you've done a deals, but let's talk about the latest, probably the GPT transaction. Can you tell us a little bit about what you can?
Yeah, so we just before Christmas, we exchanged contracts on about $250 million worth of industrial properties with GPT to NashCap, which is now I think called Wentworth Partners, for their fund, which has taken their fund from around 800 million to I think around $1 billion. Pretty strong result. Industrial sector is still pretty positive because there's very strong rent growth coming through. So the blended yield on that transaction, I think, was around 4.7%.
Wow.
So you might think in this interest rate environment that's tight, but there is very strong rent growth coming through in industrial. So it was a good deal for both parties.
Yeah, that's great. Well, let's just dive in now. Let's start with industrial, seeing what we've started on that. So what's going to happen in 2023? Like, we've had interest rate rises. We had another one yesterday. We all know that it's probably not the end of it. With the financing, that increase, what do you think is going to happen? Let's start on industrial first. So we think that there will be rental growth.
Yes.
It's got to be rental growth. Like, vacancy is next to nothing in most capital cities for those large kind of distribution type facilities. So where do you think it's going to go?
So I think the focus for sheds is going to be on the unit estates. That's what we used to call them when I was a kid, unit estates. I think we now call them last mile logistics.
I still call them unit estates.
Yeah, because you've got a number of tenants, you've got lease expiries where you can capture the inflation and the effects of that rent growth. So I think that there's going to still be, that's probably the preference, or the stronger weighting of capital will be towards that last mile sector.
So isn't that interesting that, in the past it's always been looking for that long WALE, but it's really going to turn around with the prospect of that rental growth, find that kind of short WALE assets?
That's right. So your big box sheds, that might have a 3% per annum increase, when inflation's running at 7.8.
Yeah, not attractive.
It might not be as attractive as being able to capture that rent growth through the lease expiries coming through in unit estates.
So who's looking for these assets and where is the money coming from? That is the big question.
Sure.
Where is it coming from?
I think it's fair to say that most of the money's from offshore still.
Okay.
And there's still new entrants coming into the market, mainly American-based companies. So I think that trend will continue.
But why Australia? Why are they going to put their money in Australia? There's other markets out there, like we know the Canadas of the world, and Japan is still getting a lot of those overseas investors in there. Why Australia?
Look, it's a weighting towards Asia. And so Australia, whether it be commercial, retail or industrial, seems to outperform, because if you're looking for an Asia-Pacific weighting, it's much easier to get set in Australia than it is in other markets such as Tokyo or South Korea. And China's not great at the moment. No. It's gone backwards in terms of people's expectations. So, I think typically Australia bats above its weight because of its transparency and its access, rather than some of these other markets where, because of, political issues or socio-political issues, it's harder to get into those markets.
Okay, so you still feel pretty confident on that industrial side of the market, and it's really got to do with that, the fact that we've, our demand supply unbalanced.
Yes, yeah, no, that's right. There's a lack of supply in that space.
And there's probably isn't a whole lot of new construction going on. And also, particularly in Sydney, we just have that kind of fundamental lack of land.
Well, the land, that's right. I mean, we would implore our councils to get on and rezone land and get the services. So it's one thing to have the services, but another big issue for industrial and supply is getting the services to that land.
And do you think that there's a precinct, just talking on Sydney here because you're a Sydney sider, will there be kind of is there a greater interest in a certain location? Is it kind of heading into that southwest precinct like it always has because we're going to have the airport there, or is it just all over anywhere you can get it, I suppose?
The feedback is land anywhere, please.
Okay.
But very few people are set in the airport, in the new airport. So I think that's going to get a high focus.
Okay. Yeah, interesting one. Let's move on to office, which is an area that I know that you do a lot of work in, you have for many, many years. And the office market report just came out last week. Not surprising, vacancies are still pretty high, particularly in Sydney and Melbourne, which is, they're our landmark, internationally known office markets. So what do you see there? We still have the issue where people aren't in the office. They're still working from home, and we'll talk about that a little bit more. But what's your thoughts on let's talk just those kind of office markets at the moment?
Yeah, sure. So I think things are better in terms of the volume of people going to work.
Mm-hmm.
Anecdotally, this time last year, let's say for Sydney CBD, it was about 20%
that's right.
footfall through buildings. The deep, in-depth research I've done, spoken to two owners, it looks like that's gone from 20% to around 60%.
Yeah.
But dominated by Tuesday, Wednesday, Thursday.
Yeah, and that's echoed by a lot of those transport statistics. So New South Wales, they do the statistics on the Opal card, people going on the train, and Mondays and Fridays are quiet as. It's really a Tuesday, Wednesday, Thursday thing. But surprisingly, everyone's coming back into the city on a Friday. So good for the nightlife and vibrancy of the city. But it's it's still a Tuesday to Thursday thing.
Well, I guess it's important to come in on a Friday after you've been working hard on the beach all day on Friday. So
yeah, and they're coming out like
you're probably a bit stressed.
Which is a bit lying on the beach well. So you're not working until 5 o'clock. They're coming in at 5 and having drinks with whoever's in the office. But yeah.
And look, interestingly on that trend, if we look overseas, some of the stories coming out of San Francisco, which is obviously a tech-dominated market, are pretty scary.
Yeah, definitely. Massive
redundancies. Also, people, I forget what the company was, but they occupy 26,000 square metres in a landmark San Fran building, and they've reduced their occupancy to 1,000 metres and told everyone to stay at home.
Wow.
So typically, the US and international markets are ahead of Australia. So maybe in the tech sector, that's where we might see some permanent.
Yeah. I was going to say maybe more about the industry type. Yeah.
And I'm sure that small to medium businesses have a much stronger position on getting their staff back to work than the larger businesses who have a bigger percentage of back of house operations.
And what about, so there has been some leasing transactions still occur, but is that really just more like shuffling space around? Because absorption is...
Yeah, net absorption seems to be either flat or negative, isn't it? So, look, I think that most leasing agents are walking around town at the moment with a smile on their face. Yeah. And I think a lot of that's to do with the fact that incentives have increased dramatically from where they were 3 years ago. And I think a lot of businesses are taking advantage of that and saying, let's create a new environment. Let's change it up and perhaps look at the way we work and the nature of our fit out to attract people to come back to work.
Yeah.
So I think there's going to be a lot of activity. Flight to quality has been a definite thing.
I hate that term, but anyway.
As much as we hate it, it's true.
It's true. It's true.
Yeah.
If you can get an incentive and you can get a premium or A-grade quality asset and move up from your B-grade, why wouldn't you? And you can see that with the vacancy in the B-grade is trending a little bit.
Yeah, that's right. And also I think heritage buildings are going to have a very strong focus.
Yeah.
We're talking to people more often than ever about wanting to get set in a heritage building because it offers that different environment, something completely different to what people are used to working in as a way of attracting staff back.
We need to get back onto the investment side of things, but before we talk about that, that was really a Sydney-Melbourne discussion. But Brisbane, Perth, I know you don't do a lot in those markets, but like I was in Brisbane last week, and there's far more people in the office. I was talking to some people and they're saying it's so damn hot up here. Everyone wants to go to the cool air conditioning because as soon as you walk in, it's, much more comfortable. Yeah. But they've seen vacancies reduce. They've seen absorption up, and those fringe markets as well. So Brisbane fringe has gone up. West Perth has improved as well, which is a bit of an odd one. And Perth, but again, flight to quality. Incentives are playing a role there. But those markets that had the kind of strong population growth, there's more people there. That seems that they didn't have the same lockdowns, I suppose. So they didn't have the same massive reduction in people coming to work.
I think that's definitely the case. And if you look at Melbourne, which lags Sydney significantly, had the harshest lockdown. So I think that thesis probably follows through to those markets.
Yeah. It's an interesting one. But anyway, in terms of the investment, so is there still, knowing we're going to be in this period of high-ish vacancy, high incentives for a little while, interest rates are high, who's buying office buildings?
Yeah, I wish you hadn't asked me that. The demand for office is down. And while ever there's this uncertainty around about what is the future of office and what is going to be the demand for it, it's people are going to want to see real value. And if we look back to, when interest rates were at their lowest, when they were at 0.1% official, and the best borrowers were borrowing well under 2%, yields got down to, circa 4.4%, 4.1%. Fast forward 18 months, that debt is probably worth somewhere between 5.5% and 6.5%. So that has a dramatic impact on your returns.
There's still offshore money looking.
Yeah. And I think so there are positives. I mean, the downturns are negative for some and great opportunities for others.
For sure.
And I just think it's about timing when that capital will come back into the market. It's not that it won't, it's just when will it. So I think the value of your dollar is certainly more valuable today than it was 2 years ago. Mm-hmm. If you've got money back 18 months ago, if you put money in the bank, you got what, 0.2%, you got nothing. Now you get 4.25%.
Yeah.
So the value of someone's dollar now is a lot more valuable, and they're going to want to see that in terms of the returns that they're after. But there is great news in that there's going to be no supply. Construction costs are up significantly.
Yeah.
So it makes it harder and debt availability of debt will make it harder for the development cycle to kick off. So there's going to be a reduced supply. I think the trend will stabilise and people will come back to work. I don't see that as being maybe for some sectors permanent, but certainly not every sector. And at the end of the day, it's small to medium-sized businesses that drive demand for office space probably more than we realise, and rather than the larger companies. So I think the outlook's positive. And I think post GFC, I was amazed at how quickly the market came back.
Sure, yeah.
It didn't do this. It was a J curve, yes. Right? And I can't see why, with the amount of capital that's around, that there won't be a J curve style recovery.
Yeah, that's
for office as well. It's just when.
Yeah, but opportunities in those kind of other markets, I suppose, particularly from domestic investors, like they'll be looking at those kind of Brisbane markets or those kind of Gold Coast and those sort of markets which are actually trending rather well.
Yeah.
And there's opportunities there. So there's always those.
That's right. And not everyone has the capital to play in the biggest markets.
Of course.
Right. So deal size and availability will drive opportunities for sure.
So we know that there are some groups that are doing some pretty significant, capital raising. Where do you think they're going to land? If they're looking at, like you said, there's a weighting towards those kind of Asian investments and Australia falls into that pan-Asian investments. Where do you think? Do you think that's more of an industrial story then?
I think in the short term it's industrial, and then I think as it becomes a bit clearer about office and where it's headed, then heavily towards office. It's really about, and it's going to be about getting set in Sydney and Melbourne first, the major markets.
Yeah.
And then the capital will flow from there to the other markets.
So this is the thing, is that like where these markets are considered international office markets, if you like. So, if there is an offshore group coming, chances are they'll be looking at those markets.
Absolutely. Yeah, the gateway cities.
Yeah.
it's much easier to explain where Sydney and Melbourne is to someone than where Perth or Brisbane is.
Or
if they're sitting in New York.
But there has been quite a bit of international investment into Canberra. It's a hard market to understand, though.
Well, Canberra should be looking good because traditionally the Labor side of politics employs a lot more people.
Yeah.
So I think Canberra could be a bright spot in the short term.
Yep. Observation. How about retail?
Well, I'm not smart enough to know anything about retail. So, I can't offer many insights into that. But what I can say is that if you owned a neighbourhood shopping centre at the moment, which is dominated by Woolworths or Coles or whoever with a turnover rent, you're getting some good growth at the moment because of inflation. And it's pretty obvious that the RBA is looking to slow the economy. Obviously, they're going to try and manage a soft landing rather than a recession. So you would think that there's probably a bit more pain to come for the specialty-driven part of the retail market.
Retail's an interesting one. I've been saying for a long time that a lot of those retail assets will kind of transform and add new uses to them. And also let's remember they're on large parcels of land, well located with transport and stuff. So, where's the upside?
And what are we going to do about, integrating medical and residential and aged care into these shopping centres?
Yeah.
And that's a trend that I think we're going to see on those bigger parcels of land. And it just makes sense. It's inefficient use of land, and particularly big sites, to have one or two levels on them.
Yeah, and they've got public transport usually there, and there's so much going for them. Just to take a step back, something that you mentioned in terms of the construction costs, they've been high for a little while now. Can you see, what's your thoughts on that? Is that going to ease? Do you think it's going to be around for a little while?
You'd suspect it's going to be around for a while yet. And I wonder how much construction prices ever come back.
Yeah.
Once they're locked in, it seems like they're locked in.
It's more an issue not really an issue. It's more of the trades. So if it was only a couple of years ago that you couldn't get a trade to save your life, and that kind of added to that already increased construction costs. But if there isn't as much construction going on, there might be some availability of those trades.
Yeah, so you'd think that naturally would help. What would be really great would be to have all the people that left the country pre-pandemic come back, because that's created such a major labour shortage in these areas. And you wonder when people are going to start to come back here and start working again.
Well, this is the thing with migration, I suppose. So the recent migration stats came out, and it was probably higher than they anticipated. So it's a double-edged sword there.
Well, I'm talking the short-term stuff with people that used to come here and work for holidays and
for sure.
Yeah.
But the migration information is kind of interesting, because then what does that mean for housing and stuff as well, which is a whole completely different topic. But
well, in Globo land's being affected at the moment.
Yeah, for sure.
There's a consequence of higher rates and construction costs. But immigration's such a great thing for Australia. So let's keep it happening.
Yeah, that's right. One thing that just talking about that migration piece, and we didn't chat about this, but do you have a thought on the student accommodation market? With China has just released they've made those changes, and they've said that, we're not doing online learning. So I expect that all those Chinese students who were very slow at coming back to Australia are going to come back very, very quickly.
Yeah, I would have thought everyone in that sector would have been doing cartwheels.
Oh, for sure.
Last week, when that was announced. So I think we can expect that to be very strong.
And I think that there's probably an opportunity for some more development in that space, because we're before you know it, it's going to be already the occupancy was pretty high from domestic students, just because to rent it was so high.
Well, we undervalue the impact of education. It's in our top 5 exports.
Yeah, for sure.
I think it's iron ore, coal, maybe tourism, and then education, or education and tourism around the other way. So that's a massive part of the sector for the economy. That area growing is typically good for office, because it reduces, often they're converting office buildings into student accom, and that helps us with vacancy rates.
Yeah. Well, actually, I got asked that question just yesterday, saying, will some of those office buildings, because of, in CBD locations, do you think that there's an opportunity for them to repurpose? This is a complete flyaway question, but you brought it up.
It's always
something. Yes, it is your fault. Into student accommodation, could that happen?
Oh, look, I think definitely it will happen around the key universities and where that existing infrastructure is. And look, remember early 90s. Some of us can remember the early 90s. That was a big driver for net absorption, or fake net absorption, as office buildings were converted to withdrawn. Is that the word?
Withdrawn.
I call it fake net absorption.
Yeah.
to resi, and I think we'll see that continuing. What I know, Sydney Council is worried about maintaining the size of the CBD market for office so that it doesn't lose relevance. So it might be harder than we think, perhaps, to get major residential projects or student accom projects off in the core of the CBD than previously. But it's certainly going to be a positive, and people are going to look to it.
But maybe there is an awful lot of CBD assets like those kind of strata, older strata. I suppose that's hard to do, and it all takes time to kind of amalgamate and do something with those.
Yeah, but we've seen a lot of activity in that. In North Sydney, there's buildings that have been de-strated, if that's the word.
Yeah.
It's
I
happening.
understand what you mean.
It's happening in the Sydney CBD. I mean, one of Sydney's best development sites at the moment is 23 Hunter Street, which was a strata project the site's been amalgamated. So that's that's a good thing. Maybe strata owners are saying the returns aren't as good as what they were, and they might be looking to sell more readily. So,
well, strata, like there was a massive resurgence in strata activity
when interest rates were historical.
When interest rates were nothing.
It was cheaper to own than lease.
That's right.
And now it's the balance is probably heading the other way.
Yeah, but a lot of investors jumped into the market. So so getting those and still on those really, really tight yields, which are probably not going to be there for a little.
Probably not going to be. I'm just being a bit reticent because we don't want to be too negative, do we?
No, but it's true though. But I think that, like you said, the interesting part of this is this funding piece.
Yeah.
And the money is there. It needs to be invested. And Australia is a key investment.
So when the capital decides the time's right and the value looks appropriate to the risk-free rate, the money's going to pile in. And it's no different to what happened post the GFC.
Yeah. Just a way.
There is a way to capital, but it's selective capital, and returns have to change. The risk-free rate of investing's changed.
Yes. And
in the same way that we followed the yield curve down, on the flip side, we're going to be following the yield curve up.
Yeah.
But probably with high growth.
Yes.
In rents. And a shortage of supply in the medium term because of no development cycle. So I'm not saying that it's going to move perfectly in tandem with higher interest rates, because there is going to be growth to cover that as higher costs.
Yeah. Well, we know that even with office markets, while their incentives are high, like the face rents are still showing growth. And
I think we're yet to see it, but with inflation at 7.8%, well, we're just running a model this morning. Building with over 80 tenants on it in the city, A-grade building, about 60,000 square metres. You can all try and work it out if you like. There was a bit of misinformation there, so they won't be able to. But, we're saying that for the next 12 months, well, let's put our market rents up by 7.8%. Or should we add a bit more so that there's a genuine margin above inflation? So, it's a great time to own a building. You're going to get this inflation pop. Eventually, inflation will drop, but your rents should stay where they were.
That's right.
So if you're looking at getting up to, let's say it's 7.8% this year and it's 6% next year, that's a compounded 14.5% in 2 years growth.
That's right.
That offsets a lot of the increases in your interest cost.
Yeah, definitely. And so then once the market starts to normalise, we see the incentives come back down, or then your starting rate is already at that high rate.
And I think this is the key signals that the capital that's sitting on the sidelines is going to be looking for.
Yeah. So let's just let's finish up with just recapping on, so what are the opportunities? Let's start with industrial, that short WALE. I thought that's just so fascinating, that short WALE piece.
Yeah. So short WALE it's obvious.
Yeah.
Right. The rent growth's there. You've got the opportunity to capture your inflationary growth. And so everyone's going to be chasing the unit estates and the last mile. So that's going to create opportunities in the long WALE stuff, where yields are going to probably move out a bit more than they are for the short-term leases. So I wonder, as a counter-cyclical play, whether or not we shouldn't be thinking, if you don't believe that inflation is going to be around for more than 2 years, maybe you should be looking at some of this long WALE stuff where there's going to be better opportunities to buy.
Yeah. Well, I just pulled out the CPI forecasts for Dave just before we came in, and it's the expectation is that at least 2 years there's going to be that strong.
Do you know one of the great ironies? And everyone's going, well, we're going to have a recession. This is great because then interest rates are going to go down. And it's like, well, I've been through 4 recessions. It's not great.
Yeah. That's
and we only had one proper one in my lifetime, which was the early 90s.
Yes.
The 2008
GFC.
And GFC wasn't as bad as the early 90s. So, please don't get too carried away by thinking that it's all about interest rates. Investing in property is not just about one thing. It's a cake, and the cake has a number of ingredients, and it's not all just about interest rates.
And also, historically, commercial property there, it's a long-term investment play.
Correct.
As well. So there will be blips in the road along.
Absolutely. But I think, so industrial, sure, it's obvious that the rent growth's there, but let's not discount the longer WALE stuff because it might be getting discounted. And if you do have a strong level of conviction about the inflation cycle and where interest rates are going, maybe it's going to show some value too.
Okay, and so that's industrial, opportunities industrial there. Office?
Office, I think it's going to be about the key markets, Sydney and Melbourne first. That's where the liquidity is going to come from. And then the real one is, can you get hold of a heritage building?
Yeah.
Or can you get hold of a different building that you can make super attractive? Let's call it non-traditional. Okay, we're not in a traditional old office building. We're going to a new funky space that's got all this benefit and whatever things. So what can you do to differentiate your building? And I think they're going to be in very strong demand.
Well, it's about, like you said, attracting that staff back into the office.
Yeah.
And like no one's really worked out what that formula is.
Yeah.
Is it breakout areas? Is it meeting rooms? Is it big spaces? Is
it high ceilings?
Is it the hot desk, or I don't want to, or do you want to have your own desk? There hasn't been, we don't know what the opportunity is, and we don't know what the right recipe is, if you like.
Yeah, that's right. And that's going to be user-led.
Yeah, okay.
And also, so the big opportunity is because of the nature of the market we're in at the moment, there's going to be no development.
Yeah. So
when it pops, it's going to pop aggressively. And I'm not sure that we're seeing it yet, but is the high inflation going to transfer into market rents? And if it does, we're looking at 14.5% compound at the next 2 years, roughly. Pretty attractive.
I think it will. I think the incentives, I think the effective is a different story, but I think those face, just because once we have moved through this cycle, then we have that new kind of
and then the incentives start trending down, and you're in clover.
That's right.
You're powering. So, and that's when that becomes clear, when that time is, when someone rings that bell.
Yeah.
That's when the money will pile back into office. Yeah. So let's not panic too much, because I think the growth that's going to come through is going to cover other sins.
So that's for those kind of major markets. I actually feel pretty optimistic about those, like WA and Queensland markets, just in terms of that population growth. There's kind of more activity going on there. Like the same thing, incentives will remain high, but I do think that there'll be those kind of rental growth in there. And there is absorption, which is, good news story.
Well, the thing about Brisbane and Perth is that people are used to those incentives. It hasn't been the dramatic jump.
Yeah.
So we haven't seen incentives change. So whereas in Sydney they've gone from 15 to more.
Yeah.
More. I wouldn't like to say 40.
Yeah, let's just no. We didn't say that. We just say more.
Let's say 35.
Yeah, okay, more. And retail. Well, let's say retail. We're not retail experts.
Yeah.
But opportunities. There's definitely going to be rental growth in there if you've got a supermarket anchored asset. And that's the thing, it's that convenience retail is still going to hang around. But we do like the online shopping, which is going to feed into that last mile piece on industrial.
And the counter-cyclical story is consistent across all three sectors.
Yeah, for sure.
Right. So that's just timing.
Yeah. And the last thing that we mentioned that I didn't think we were going to talk about is student accommodation, and maybe there will be some
student accommodation could be a real highlight. There's still money for build to rent too.
Oh yeah.
And I don't know that we necessarily do build to rent in Australia. No. I think we still think it's owning a block of flats and letting it out.
They're trying. There's a few.
Yeah, and there's people that understand that have done it well in America, and we're seeing them turn up. So maybe that's going to take some of the sites, create more competition for those sort of sites that suit student accommodation and resi. Yeah. Maybe we'll see a genuine attempt to get the model right on student build to rent.
Yeah, well, they've changed the legislation as well around boarding houses and stuff too. So that's all kind of feeds into there's changes happening in that part of the market. So and with residential vacancies so low and this pipeline of new stock pretty
so that could be a bright sector too.
Yeah, interesting one. Okay. Well, thank you. I think that kind of ends our chat today, Ian. Thank you so much for joining me and talking all things commercial property and what we think is going to happen this year.
Well, I'd like to see what happens over the next 12 months, so let's do it again then.
Yeah.
See how many lies I tell.
No, we know this is the wrong. That's the wrong answer.
Sorry. See how right I was.
Never mind. But thank you. Thanks, Ian, for joining us. And we're back on track. We'll be doing these once a month. Our next one is the 8th of March. Details will follow shortly. However, we're going to be up on the sunny coast. So talking about some of those coastal markets, those drivers that are happening up there, and looking at industrial office and tourism, lots of stuff happening in sunny coast. Have you been there lately?
No, I wish. I just
beautiful.
Work all the time. I never go on holiday.
Well, the Maroochydore office market's doing pretty well at the moment.
Go and check that out.
All right. So thanks for joining us, guys, and we'll see you next month.